All right, so my last video on option selling passive income, 1 hour per month, selling SPY put credit spreads every Monday, Wednesday, Friday did well. So as you can see here, it did pretty well. So I'm going to do another one, but this time instead of comparing the SPY or talking about the SPY, I'm going to talk about one of our favorite stocks, which would be Tesla. What would the probabilities look like on Tesla if we sell a put credit spread every week on Tesla with 28 days to expiration? Now Tesla, if I go to Yahoo Finance, go to options and then look at the expiries, it doesn't have every Monday, Wednesday, Friday expiries like the SPY. It doesn't have 3 days a week expiries. It has once a week expiry, so every Friday, as you can see here. So what I'm gonna do first is I'm gonna go to historical data. I'm gonna extract all the data. I'm gonna click on max here. So it doesn't, also another thing, it doesn't go as far back as the SPY in 1993. It goes as far back as 2010. So I've got about 11 years of data, so not as much as the SPY, but I'm still going to use it. Click apply, and then I'm going to click download. So I'm downloading all the prices on Tesla. I'm going to remove adjusted close. I'm going to remove volume. I'm going to keep open price. I'm going to remove high and low, and I'm going to keep closing price because I want to compare. I'm basically going to open a put spread on the SPY, not on the SPY, sorry, but on Tesla at the open. Every Friday at the open, I'm going to open a put spread on Tesla, and I'm comparing it to the closing price 28 days later. So I'm going to keep both columns, but what I need to do is look for the Fridays because I plan on opening them on Friday. So I think I have to use a function called weekday, I believe. Yeah, weekday, and then serial number, and then return type. So yeah, let's click on the date, and I think return type you can put numbers Sunday through Saturday, so 1 to 7. So if the beginning of the week is a Sunday, so let's do beginning of the week is a Monday, so it'll be return type 2. And so Friday will be Tuesday, when Friday will be 5, I guess. So yeah, let's do return type 2. So this suggests that it's a Monday. Let's scroll a bit and just test it out. So a Friday, so July 2nd, 2010, July 6th. So 6 is definitely a Monday. 6, 7, 8, 9. And then 12 is a Monday. So 9 is a Friday. So it looks like Friday is number 5. And here we have, 15, 16, and then 19 is a Monday because there's 3 days apart. So 5 is indeed but how come Monday shows 1? Monday should be a 2. So let's test it out a bit more. So we've got July 30th, August 2nd. Anyways, it looks like 5 represents Friday. And then we've got July 16 and then July 19. And then, what about 29? 29, 30, 1, 2. Okay, so 2 is a Tuesday. So 1, yeah, all right. So 1 is a Monday, 2 is a Tuesday. So 5 is a Friday. Okay, perfect. So I'm going to apply the formula everywhere. Scroll down just to make sure everything is covered. So now I'm going to filter. I'm going to keep Fridays only. That's all I want. So I'm going to remove Friday and just delete everything in between. Now I do acknowledge that sometimes Friday market is closed, so I might be missing out on certain Fridays, but it's okay. I'm not going to make it more complicated than this. If I miss out on Friday, then some of the data will be incorrect, but it's not going to be it's not going to be enough to ruin the overall probability or conclusion. So okay, so here all I have here is Fridays. And now I want to compare from Friday to Friday, 28 days later. So 28 days later is 4 weeks. So if I start off with July 2nd, this is 1 week, this is 2 weeks, this is 3 weeks, and this is 4 weeks. So this would be 28 days later, which makes sense. July 30th minus July 2nd puts me at 28 days. All right, so now the formula, similar to the video on the SPY put credit spread strategy, the formula will be comparing the close, so the close divided by the open of the first day. As you can see, it's showing that in this case, it actually dropped 15%. the closing price 28 days later represents 86% of the opening price on July 2nd. So that's just one data. Now I want to do I just want to look at the difference. So I'm going to do 1 minus this, and then, so yeah, as you can see, it dropped 13%. Actually, I want the opposite. I want this to minus 1. So it's a negative 13%. And then I want to round it to 2 decimals. So yeah, so let's do round parentheses, comma, 2 decimals, another parentheses. There we go. So now we've got a minus 13. And then I'm going to scroll, and I'm just going to spot test the formula. So let's look at the next formula here. So I'm comparing C7, which is correct, which is what I want, the closing, to B3, which would be the next one here, of the opening of the previous 28 days. So yeah, makes sense. Perfect. All right, so formula's good. I'm going to scroll all the way down to make sure the formula is applied, and let's just save it in case. All right, so you agree that these are all my Friday to Friday from open to close 28 days later, the movement of opening price compared to the closing price 28 days later. So I'm gonna copy paste all these values. I'm gonna take it on a separate tab here, paste as values, and then next I want to count how many times do these values show up. So equals count if the range is here and the criteria is the cell, close parentheses. So negative 13% shows up 12 times, and if I apply the formula everywhere, 11% shows up 16 times, and so on. And then I'm just going to sort. So I'm just going to sort from I don't know, largest to smallest, and I just want to make sure that I don't have duplicates. So I'm definitely going to have duplicates. So here are some duplicates here. So I'm going to remove the formula. I'm just going to copy paste as values, and then I'm going to highlight everything and just remove the duplicates. Click OK. So now I'm just left with unique values, but it shows me that there was one occurrence where the Tesla was up 93% 28 days later. Actually, let's go find it. I'm just curious, when was Tesla 98% higher 28 days later? So 93%. So that was May 17th, 2013. Yeah, okay, so it was still when it was cheap. Open, close around $18. So it must have been probably around $10, I guess, before. So around end of April, it should have been around $10. So let's go make sure. So we said it was what, May 2013, right? So let's go to May 2013, or let's go to April because that's 28 days before. So yeah, makes sense. Yeah. All right. So yeah, makes sense. Good. All right. So now that we have the number of times these movements or these change of price occurred, now we can just compare the percentages. So I'm just going to do this here divided by the sum of the column. So now it's showing me in terms of percentages how many times it occurred. I'm going to show it as a percentage, add 2 decimals. Okay, so 0.18% of the time Tesla was up 93% 28 days later. So obviously it doesn't happen often. You could see that 3% of the time Tesla was flat 28 days later. Now I want to add up. I want to see how many. Now I'm going to add the cumulative percentages just to see, for example, what's the percentage that the Tesla is either flat or higher 28 days later. So I want to add, for example, all this together. So I'm just going to put a simple formula here. This equals this, this equals this, plus the previous percentage, so this, and then I'm going to scroll down. So this column should give me 1, and this here at the bottom, the last one should be 100 because it's basically adding up all this. Okay, so now I'm just going to put some nice colors just so it's obvious. So color scales, anything really, doesn't matter. All right, so remember with the SPY, I think we had about 68% of the time the SPY was either at the same price or higher 28 days later. Now with Tesla, you could see that going from Friday to Friday, 28 days later, it's only about 59% of the time. So it's a little bit less than SPY, but it's still more than half of the time. So more than half of the time, SPY is not SPY, but Tesla is higher, either the same price or higher than its original price 28 days later. So that's still a good edge. And if we go down, let's say 3%, we're up to 68%, while the SPY 3% lower was around 80 something percent. Where can we find the 80%? So 80% shows us that we have to have a short strike basically of 9% lower if we want that 80% probability. So the short strike will depend on expected move. So it's not something we can control every time. And the expected move will vary on the volatility, so on the general VIX environment, but also because it's an individual stock, it'll depend on any news or announcements coming up for that particular stock. Could be earnings as well, could be deliveries in the case of Tesla, whatever, battery day or whatever it is. So any particular unique event on the stock, on the company, could create an increase in volatility. Therefore, expected move will be higher. So for example, we can go see what the expected move right now is. So if I just go back to Yahoo Finance, I go to options and I click on straddle just to view it as a straddle, and I want 28 days later. So we're July 7th. So 1, 2, 3, 4. It's going to put us at around August 6th. That's the closest thing to 28 days later. Stock is at 644. So the at the money straddle is worth around 41 plus 50. So my expected move is around 90 points. Now in terms of percentage, 90 divided by the current market price of 640 is about 14%. So if we go to 14%, you could see that if my short strike is 14% lower based on if I take a short strike that is at expected move, so 640 minus 90, that puts my short strike at right now would be around 14% lower than the current market price. And if we go to our 14% here, it shows that based on 11 years of data, Tesla has been above, or Tesla doesn't drop more than 14% of its current market price 28 days later. That happens 91% of the time. So 91% of the time, picking an out of the money short strike that is 14% lower than the current market price will be a winner 28 days later. So that's what this means here. So it's actually pretty safe. So if we actually go, let's go to Questrade. I'm going to open up Questrade and let's do an out of the money put credit spread on Tesla at the expected move. So let's look up Tesla, and then I'm going to look at the straddle value. I'm going to pick August 6th expiry. Current market price 644. So it's about 88, 90 points. So the short strike that I'm gonna pick for my put credit spread will be 644 minus 90. So I'm gonna pick a short strike at 555 about. So I'm gonna switch it to a vertical. I'm gonna click anywhere, and then I'm gonna adjust here. So 555, right? Yeah, 555. So there isn't a 555. There is a 560. So let's just do 560 and 550. 560 and 550. So that's a 10-point wide put credit spread, and it's showing that I can collect about somewhere in between $1.20 and $2.45. So probably around $1.70, maybe even more, maybe $1.80. So it can collect about $1.80 on a 10-point wide put credit spread. But what's more important to note is that based on these probabilities here, because my short strike is 14% lower than the current market price, this spread here has a 91% chance of winning. It has a 91% chance of being out of the money 28 days later. So today we're July 7th and I'm opening it 20 days later. So based on probabilities, it has a 91% chance that this short strike is out of the money. So that's what this means here. Now, that's because our expected move right now is 14%, but it won't always be 14% lower. It really depends on the volatility of the individual stock. But you could use these probabilities to help you decide whether it would be a good entry or not. I think 80% is good. So if your short strike is at least 90%, not 90%, sorry, but 9% lower than the current market price, then it would be a good entry in my opinion. But you could still see that there is an edge. I mean, 59% of the time the stock is at least at the same price or higher 28 days later. But the problem is, what this means is, if 80% of the time you win $1, for example, if it's a 5-point wide spread and you collect $1, if 80% of the time you win $1, then you'll make 80 cents. But then 20% of the time you lose $4, then you still lose 80 cents. So it becomes a zero-sum game. So the advantage here, or the edge, comes in either managing your trades at 50% profits, or making sure that you don't lose max loss. That when you do lose, it's not max loss. And you could avoid max loss by selling a call spread against your put spread that is breached, which I mentioned in my previous video. So if you feel a little bit confused, watch my previous video where I talk about the SPY put credit spread strategy, so to better understand this video here. And in this video, I'm just doing the exact same thing as I did in the previous video, but I'm just talking about a different stock, which is Tesla. And because it doesn't have 3 days a week expiry, it'll be once a week expiry. So it'll be a trade that you open every Friday morning, and then 28 days later expiry. And based on these probabilities, you want a short strike that's at least 9% lower if you want to open trades that have 80% chance of winning. With the current market price of Tesla at 644, that means you would need at least a short strike of 586 if you want an 80% chance of winning based on 11 years of data. And here's why I prefer put spreads over call spreads. So what if we looked at this in the sense of a call spread? Why don't we open a call spread instead of a put spread every Friday? From one Friday to 28 days later, we open a call spread instead. Well, so here when we're comparing the put spread, we're starting from flat anywhere higher just to see where the edge is. And you could see that the Tesla 28 days later, 59% of the time it is trading either at the same price or higher 28 days later, 59% of the time. Now let's do the opposite. Let's see what if we want to look at trading at the same price or lower. So that would be a call spread. That would benefit us that's how a call spread would benefit us, is if Tesla is trading at the same price or lower. So if we highlight these percentages, we get 44%. So as you can see, it is less likely that Tesla is trading lower at the same price or lower 28 days later. It is more often that it is trading at the same price or higher 59% of the time. And then if you want to make the trade even safer, you take an out of the money short strike to give yourself an even higher chance that your short strike is out of the money at expiry. So if you're selling a put credit spread out of the money short strike, then it has a better chance of winning. And the lower you can go, the safer the trade. But obviously it depends on expected move. You want expected move to be high so that you can collect at least a decent amount of credit. Right now, as you can see, with the current expected move, I usually like to collect at least $1 on a 5-point wide spread. So if on a 10-point wide spread, I would want to collect $2. So that's not what I'm getting here right now. So it's not bad. I mean, it's still $1.80. If it was a 5-point wide spread, I'm pretty sure I can get $1. But the August 6th expiry does not have 5-point wide strikes. It's all 10-point wide strikes. But if I did, for example, 570, if I came a little bit closer, 570, 560, I could definitely collect $2. So yeah, in this trade here, it's exactly $2 in the middle. So I could collect $2 out of this one. And let's look at the delta. It shows me a 16 delta. So in theory, the delta means the probability of being out of the money. So this has a 16% or of being in the money. So this one, based on delta, the short strike has a 16% chance of being in the money. And remember, for this to be a max loser, it doesn't have to breach 570. It has to breach 560 to be a max loser. If it's at 568, if Tesla's at 568 at expiry, it's not a max loser. It's just a break even because it'll be worth $2. So the true delta, or the true probability of a max loss on this spread is 13. So there's a 13% chance that this Put spread is a max loser based on the delta of the long strike. That's if you want to use delta as your reference point for probabilities. I prefer to use actual results, actual past results. All right, so if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to sell options, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share it with a friend, and subscribe to the channel. Thanks for watching.